Good morning, good afternoon, good evening, everyone. My name's Dipesh Patel, editor at Trade Finance Global and host of the podcast Trade Finance Talks. COP26, also known as the 2020 Glasgow Agreement, didn't really produce the breakthrough that many had hoped, although the final agreement did promise actions to limit warming to 1.5 degrees. The commodities sector accounts for a huge proportion of the world's carbon emissions, and although ambitious net zero targets have been set, the roadmap towards this is very unclear. Add to this a commodities supercycle, an oversupply of LNG, and a pandemic restricting the physical movement of people and goods for nearly 24 months. Today, we're talking about what all of this means for the commodities sector. What does the transition mean for energy? Is net zero really too ambitious? And how do we tread the fine balance between government policy, investor demands, and societal pressure towards net zero? In this one-hour webinar, I'm delighted to be joined by Greg McNabb, partner at Baker McKenzie, Tasneem Kruger-Valley, CEO of Kruger-Valley Consulting, and Adam Hearn, CEO at Carbon Chain. Welcome to this Reuters webinar. So to start off with, quick introduction. So over to you guys. Who are you? Where are you from? And what do you do? Greg, over to you.
Sure. Thanks very much for that. It's an interesting time for all of us on the panel. We're going to talk about our different perspectives. But for me personally, for years, I've been involved in both the climate space and the resources space. And the full intersection now is, it's quite remarkable. They used to be very distinct sectors, but the overlap is quite significant. And we're going to talk about some of those issues here today.
Thank you. And Tasneem, over to you.
Thank you. Thank you, Dipesh. I'm very excited to be here. Happy New Year, everybody. I think it's really great, as you know, the doors just closed on COP26 that we're here discussing it. For my part, I've been involved in the natural resources industry for my entire career, first as a consultant, then as a banker, and now back as a consultant. And having worked in natural resources, I have to say that environmental, social, governance factors have always been part and parcel of the risk management in the industry. So even though it seems to have become the buzzword of 2020, 2021, for my part, it's been part and parcel of what I've been doing for the past 15 years. Back to you, Dipesh.
Thanks, Tasneem. And last but not least, Adam, over to you.
Thank you. Happy New Year, everyone. Adam Hearn, CEO and co-founder of Carbon Chain. We are a platform that basically measures the carbon footprint of everything. My personal background was 12 years with Rio Tinto, several years with Amazon, and we focus now at Carbon Chain on the carbon footprint of supply chains and commodities. So that covers a majority of the world's emissions. And I look forward to sharing some of our really insightful case studies with some pioneers in this space and the insights we have from our big data sets.
Thank you very much, Adam. Thanks also. In terms of the structure of today's webinar, we'll start by setting the scene, a bit of an introduction to the problem following on from COP26. And then we're going to cover four main areas. So starting with talking about COP26 and decarbonisation, then talking about the business case, investments and policy for carbon markets. Then we'll go on to discussing rating standards from a policy perspective, and finally closing off with technology and data. We'll close off with a bit of a future view. So really looking forward to getting started. So Greg, I'm going to ask if you can help set the scene. From a business model perspective, what are the biggest issues that commodities producers and traders are facing right now?
Sure. So for some, this is a question of issues or challenges, as you put it, but for others, I think they're seeing this as a time of opportunity. Either way, it's certainly an interesting time to be either a commodities trader or a producer. Historically, both businesses have significantly relied on the ability to model or forecast both demand and supply. And in the last few years, we've seen massive disruptions on both sides of that equation. But the short list of challenges, I think, is first, the global pandemic, obviously, which impacts all the way from supply chain to global tightening of foreign investment restrictions to securing opportunistic commodities, purchasing opportunities. It's just all of that's been stood on its head. Second, a global focus on what we're calling this energy transition, that it not only shifts the demand for energy products, but increases the cost of one of the largest commodities, production and transportation input costs, like the energy required to extract and deliver. Third, I'd say violent weather changes that impact production. Those have just been, there's obviously a human factor to those, but there's obviously an impact on the commodities industry as well. And then finally, just this, as you alluded to in your introduction, this massive oil rally that I personally didn't see coming. Neither did most of the commodities producers, some of whom were selling off oil and gas infrastructure. So the trick seems to be how to market these increased costs and delivery times as being connected with a more responsible way of doing business. But some producers have embraced that, but others are still struggling with it. But it's a pretty long list of things that they're now dealing with.
Thanks very much, Greg, and comprehensive overview. Transport challenges, weather, oil rally, lots of headwinds for producers and traders. Tasneem, it's very clear also from governments, practitioners and society that the transition towards the green economy to tackle climate change is needed by 2050. And we've obviously also seen pledges from some countries saying 2070. But how can we find the balance between maintaining what were profitable business models in the commodity trading space and meeting the needs and aspirations of those aiming to achieve net zero quite soon?
That is a very good question and a very difficult question as well, Dipesh. Look, the simple fact is that businesses that fail to embrace energy transition or net zero commitments are likely to fall behind their competitors and be faced with a heavy uphill battle in years to come. And if we look at it, a significant proportion of the supply chain of larger corporates sits within the SME market. So you can already see that the pain is passing down the supply chain. And what that means is traders need to have a collaborative approach from top to bottom in any supply chain, because that's going to be the key to achieving net zero. But the reality is that only some will be willing and only some will be able to work together in this way. So making an early move towards net zero is important to maintain a competitive edge. But that can only happen if there's a robust plan in place. So businesses will need to identify and address the financial needs and consequences of adopting that early mover position. They will also need to ensure that the ability to trade competitively in the short term with sufficient cash reserves is not lost in the process. And they need to be aware of the pressures likely to come from the rest of their supply chain. So if you ask me, how do you remain profitable and what is required for a great net zero strategy, I think there are a couple of elements. The first one is to understand your future footprint. Then align your ambitions with science-based targets. And what was very exciting about COP26 this year was that science-based targets were not argued or debated. They were the fundamental foundation that everything was built around. Embed net zero into your wider company strategy. And then, as I said earlier, focus on supply chains, as these will make or break your ambitions. So it's crucial to give suppliers the support and the guidance they need. And then, if you think of every business, they have three levers. One is to avoid, so change designs, transform business by incorporating carbon into decision making. Secondly, reduce, focus on efficiencies, switching to renewables. And finally, innovate through collaboration in green finance, clean tech, wider movements such as regenerative culture. At the end of the day, significant transformation has to be a top-down approach embedded in the organization. So it's very important that this is something that's represented at the board. And I guess finally, be transparent. Communicate internally, communicate externally, communicate about the milestones that the company, the business has committed to and achieved. I think that would be my summary.
Thank you very much, Tasneem. And it's a really good kind of bottom-up approach. We know what the end goal is, and I think you've given some really practical solutions and levers there that businesses can look at. Adam, in a previous life before Carbon Chain, you were assisting moving millions of tons of ore around the world at Rio Tinto. Between then and now, how has the industry changed from the perspective of decarbonisation and sustainability?
Yeah, I think decarbonisation has really found its place on the executive agenda. So it seemed like 20 years ago, the well-equipped CEO had a really good HR strategy and was thinking about that 10-year kind of succession plan. And now the kind of slide deck of currency is, what's your decarbonisation plan? How are you hitting net zero? And if you haven't got that, you're as an executive, your board is probably looking at CVs for other suitors for the executive job who can take that approach and bring modernization to the strategy. So seeing that huge transition, and I was also really impressed with the caliber of COP26 attendees, in that you've got the best and brightest literally trying to rewire the economy, just like any global societal issue like a post-war rebuild. You've kind of got this post-pandemic era of people trying to just tackle the next societal problem. And so we will see the economy being rewired with policy that could last decades and some very passionate people doing so.
Thanks very much, Adam. And I'm going to ask you the next question as well as we go on to our next topic, really going into a bit more detail around COP26 and decarbonisation. And I think that strategy falls in quite nicely to what Tasneem mentioned earlier. Obviously, COP26 has sparked a whole series of conversations, but for commodity traders and producers, it really is quite a nuanced issue, and carefully maintaining those profitable business models from a shorter term perspective, whilst thinking about that longer term transitioning towards net zero greener energy sources. We need to strike quite a delicate balance, and it's also no secret, Adam, that supply chains are responsible for the large majority of carbon emissions. In your experience and talking from a carbon chain perspective, how can this balance be met?
It's a good way to position it. I think you've really placed the tension around that. So if I take an old saying, which is the future is here, it's just not evenly distributed yet. And I think the same is true in decarbonisation. It's quite easy for real activist-minded citizens to just say, let's shut off different plants and take drastic action. But the key to accelerating, I think, will be finding what is the fairest transition. And the reality is different regions are on different trajectories, like the EU is on a different trajectory to Southeast Asia. And I think from a carbon chain perspective, we're seeing customers allocate their low carbon products to the right customer regions, or to the most optimized customer regions, based on where they're at in their journey. So if you do have a supply of low carbon, let's say metals, you probably want to target that to Europe and areas where there is literally a carbon border coming up, and you're looking at managing that tax position, versus if you've got a portfolio and there's a higher end to your emission intensity, then you'd look to send that to Southeast Asia. So getting that strategy in place and being very pragmatic, I guess, tangible with your ambition. And so it's no longer good enough to just get a top-rated consultancy firm to put together a sustainability chapter in your annual report. You actually have to speak the language of reductions. And so companies need to be in there on the ground looking for these offset opportunities if they're having to do that and generate them themselves. And we're seeing that offsets are already incredibly expensive. So you have to take direct action, which is almost everything that the Paris Agreement really wanted to initiate years ago, which was companies taking responsibility for that carbon footprint. So I think that's how supply chains can manage this, is that they have to distribute the pain as evenly as possible, and a good accounting approach does that. And the executive leading it from the top make sure that everyone's rowing in the right direction, because if you're not doing that, you're not allocating your capital efficiently, and you're going to reduce shareholder value.
Thanks very much, Adam. I like your quote there. The future is here, but it's not evenly distributed yet. Greg, how does the sector move away from fossil fuels and approach decarbonisation in a more pragmatic way?
So Adam just mentioned about the COP 26. I mean, the one incredible thing that we have to remember about COP 26 is that, it brought together 200-ish countries to talk about a single focused issue. And, it's a bit of theater, but these countries sent like world leaders to talk about these points. And so that rarely happens in our society where we get this much of a focus on, a negotiated change. So it's quite remarkable. And so I do think we give ourselves a pat on the back as a society because some would say we're not moving fast enough, but the main thing I think is that we're actually talking and communicating about it. And so being on the ground at COP26, it was an incredible experience just from that perspective to see that many people committed to the same same kind of goal. But so just to come back to answer your question, so I like the use of the word pragmatic here. For those of us that have worked in the climate area for long enough, you'll remember that in the beginning, any talk of climate and energy disruption, back then we didn't use the word transition. There wasn't time to transition. It involved a passion. We were going to overnight, we were going to flick a switch and there was going to be immediate change and we were all going to, be green and that would be it by this time next year. And here we are sort of 20 years later. And we've seen that this transition not only takes time, but it takes money and it works differently in different parts of the world, as Adam just mentioned. So depending on who you talk to, it may not involve a move away from fossil fuels, but just to an adapted way of using them. So here I'm thinking of things like carbon capture and storage in some places. But as much as some would say we're not moving fast enough, the recent demand shortages and price escalations in fossil fuels that we've hinted at in a couple of places here have demonstrated that maybe we don't quite have the timing right yet, or that transition isn't quite perfect yet. So to answer the question, I think we have to be smart, as Adam just mentioned, about what we're transitioning to and when and where. So for example, if we're going to switch to hydrogen-powered cargo ships that create more emissions than current fuel options, then maybe we need to rethink those approaches. But we also have to remember that in the coming years, we're going to see, depending on who you listen to, a 4 to 6-fold increase in electricity demand. So not a reduction. So electricity demand is going to increase significantly. So it's just that the electricity that's in the grid, we're going to talk about how we generate that. So the grid itself needs to be expanded and improved, including the accommodation for two-way flows. So, 30 years ago when they built our grid, it wasn't meant to accept electricity coming back into the grid from home production, for example. So the more interconnection. And this will require investments in storage and things that go beyond just a few hours of overnight storage. So we need to worry about wind droughts, extended winters. So that's a long-winded way of saying that pragmatic way of looking at decarbonization. Yeah, it has to, in some ways, it has to consider a lot of local issues, but I think we just have to be smart about it. We have to plan for more than just the immediate future. We actually have to put thought into what we're trying to achieve.
Thanks, Greg. And just to kind of go back to your point there particularly on the transport sector and per a question from the audience, were the environmental impacts of the shipping industry considered as part of the commodities, as part of the commitments in the commodities sector for COP26? And are commodities trading companies really committed to addressing this? And happy for anyone to answer this question from the audience.
I can I'll add just a few sort of observations from when we were actually there. So this was actually because the transportation sector's kind of been a bit of a sleeping giant in the background. So for many commodities producers, that's down in that's down to the bottom level of your chain analysis. So, but there's definitely participation but that industry seems to be doing. It's quietly going about its business. It's quietly, it's adapting. It's looking at alternate technologies. I mean, again, you're going to find people who are saying they're not doing it fast enough, but it's a hard industry to change. It's significant, and there are going to be costs associated with that change. So, if we started saying to consumers, yeah, sure, we can change it overnight, but everything's now going to cost 4 times as much because your transportation costs have gone through the roof. People would probably lose their mind. So, but there was a focus on that. There was a focus on nature and oceans and all of those things that go along with the transportation sector. So at COP26, it was front and center, I would say, on the whole discussion.
Thank you very much. And I guess one other point probably worth mentioning here is greenwashing. Tasneem, how do we tackle the issues of greenwashing that we can still clearly see in the industry, and could probably even reference some recent guidance from the International Chamber of Commerce on responsible marketing, environmental framework. I'm sure there are many others as well to try and combat these issues.
Dipesh, I don't think these issues are new. And I remember in our last Reuters conversation, we dedicated a lot of time talking about greenwashing and the sources of greenwashing. And I think COP26 went quite a bit of way just in terms of the carbon market with the approved Paris Agreement rulebook to unlock market and non-market approaches on climate change and mitigation, right, to address greenwashing in the offset market, because a lot of people had the impression that you're just allowing polluters to pay to pollute. So hopefully, that mindset has now changed, especially when so much time was allocated to minimizing the risk of double counting. And everybody knows how long those negotiations went on at COP26. The other area that always gets a bad rap with greenwashing is, of course, the finance side, because sustainable finance and green finance attracts now trillions of dollars, and there's lots of investor money going into that avenue. But similarly, there have been a number of compliance standards and sustainability labels. You mentioned the ICC Responsible Marketing Environmental Framework, which has now been updated to provide more guidance on various environmental claims. But you've also got the International Capital Markets Association that has certain specific guidance for what green finance is, or green loans, green bonds, etc. Similarly, we've got the EU taxonomy that came out 2 years ago, and we've got the UK green taxonomy as well. But I think having all of these compliance standards are great. What would give greater credibility and give people a lot more confidence is if there was some sort of third-party verification of the adoption of these compliance standards. I don't know how my fellow panelists feel about that, but somehow I think when you've got a third-party auditor coming in and verifying, people have a lot more faith in what you're saying you're doing, rather than just saying, well, I'm complying with the EU taxonomy, for example.
Thank you. Panelists, anything to add there?
Yeah, I definitely feel quite passionately about that, Tasneem, thanks. And we've noticed from working with customers that when they get third-party verification, it not only saves them a lot of time, because some of them are just getting their ESG desks up and running and they haven't built a really deep carbon emissions team to calculate these things. But to get a specialized team that can do this verification really future-proofs headlines, so that companies don't regret something in a couple of years' time that was a bit too short-sighted on the methodology. And what exactly is a net zero purchase these days? You see many definitions thrown around, and also the market activity that is generated off verified carbon accounts is really interesting to us. So once a company knows what their actual emissions are with primary data, they feel a lot more comfortable in investing in the offsets. They know they're not over accounting, or they know they're not worrying about greenwashing. And that is a market that we hope to see evolve more, especially as the next COP will iron out those offset mechanisms.
The other thing that did come out of COP was the International Sustainability Standards Board, which is supposed to deal with some of, Tasneem, those issues are supposed to be in part dealt with that. We'll see how effective that is, etc. But I think it's a step in the right direction, because your point is exactly right. There's, the average person that's involved in or around the edges of finance doesn't want to have to do a PhD in what does that mean, and is it the same as the disclosure from another entity, et cetera. But that's always been, on the legal side, that's always been a challenge for companies. Now we call it greenwashing. We've always had it's been a problem on the other side. So we've had problems. Companies have always come to us and said, I want to tell the world about how, the great things that we're doing, and you have to rein them in. So it's almost, I don't know what the opposite of greenwashing is, but the mining sector is probably the best one to point to for that. They've done actually a more than decent job over the years on many ESG issues, but they just are so afraid to tell a good story that they do the opposite. But the problem is getting it right in terms of that balance of, being informative, being accurate, but not being misleading, and having, especially in the public finance market, just having the backup or the diligence behind you to support anything that you've claimed. But you're right, the greenwashing part is obviously, we're talking about the examples where people have gone too far, and in most cases have known or should have known that what they're saying is it's a stretch at best.
Thanks very much, everyone. And I think just to echo some of those points from the audience, so a couple of people have said that pragmatism is really echoed. We should, are we really running before we talk? The recent comment about greenwashing, very appropriate. Where does accountability stop for your company's net zero decarbonization policies? And I guess that very pragmatic step-by-step approach is necessary here. So onto the next section, and in relation to our previous section, we're going to go into a little bit more detail around carbon markets, investment and policy. And from a market perspective, and just reading on some recent stats published by The Economist last week, sustainably invested assets have continued to grow from something like $22.9 trillion US dollars to 35 trillion in the past 4 years in terms of assets under management, with a surge of interest. And but that said, more investment is needed. Their predicted investment needs to double to 5 trillion US dollars per year, and greenwashing is still rife, and sustainability rating schemes are wildly inconsistent. Greg, can you give an overview on how carbon markets and carbon accounting can work for supply chains, just to tackle some of these issues, and how this could work from a commodities traders and producers perspective?
Sure. So I mean, the carbon markets are fundamentally, and I'll talk about the issues in a second, but they're fundamentally important to this whole discussion that we're having now, especially when we're talking about offsets. So it's just a simple concept of, we're looking for the most efficient way globally to have the most, to have the most impact on climate change and reduced impact on the planet. And so our markets are set up to facilitate that. They're set up to allow, the low-hanging fruit to be easily picked. And so that's what these markets are supposed to facilitate. But the problem has been, as we know from decades of experience, because carbon markets are not new. We've had successful limited carbon-related markets in many countries, including Canada, but also in the EU. We had the CDM for years, and so I think there's two key issues in your question that we need to talk about, and we already talked about integrity, which is one of them, but I think consistency is the other one. So I think we're going to have a few people here today. They're going to have some thoughts on this, but I just want to start with a few points. But so over the years, we've seen these issues, as I said before. They're not new, and in some ways, we've resolved some of them. So I think it's important that we don't make the same mistakes twice, and we also learn from what we've done before. So with the CDM, for example, financial services and finance generally, they've both gotten a lot more sophisticated. So we have managed to control fundamental problems like not greenwashing. In other industries, we would call it misrepresentations, but also in money flows, we're now quite sophisticated in monitoring things like corruption and money laundering and fraud. So all of those things mean that we're smarter at operating things like carbon markets. So we're going to talk in a minute about technology. But we've also managed to see that some of the problems we had in the early CDM model, for example, we've now figured out how to get around them. So our carbon market solution, it's now going to be a better one than we had before. So there's that part of it. But the other thing here's where I think the consistency part of it's going to come in. At COP26, the other thing that seems to have shifted with respect to the carbon market discussion is the focus on at COP26 on nature and biodiversity. And so for me, I found that an incredibly odd thing that, I've been to a number of COPs, and we're finally focusing on a global conference about climate change. We're finally focusing on nature, and it just seemed to be an odd thing that we've kind of come full circle to talk about. After 20 years about emissions reductions, we're now all just focusing on, well, for the carbon markets, what is the output going to be in terms of nature? And so we're just now sort of turning our minds to, what that impact is going to be. But the nature side of it adds complexity of projects because it's much more difficult to measure outcomes, both in terms of immediate impact and longevity or consistency. So deforestation projects, et cetera, it's no longer just as simple as saying to a steel producer, you're going to cut emissions of X by 20%, and that's your commitment. We're now talking about preserving a nature-based resource, and so how do you translate that into something in the carbon markets that can move around and trade it properly? That's another level of legal complexity that's added to the instruments that are actually going to be traded on the carbon market. So yes, there's more money coming in, but we're also now expanding the scope of projects and things that are going to be funded by the carbon markets. So I think we have to stay focused on the integrity of the system. Just because we now have to do twice as much and spend twice as much as we did before, the same rules have to apply. We don't lose sight of the fact that we've been building towards a system that works, and we have to apply those same concepts going forward to wherever we put this additional money.
Thanks, Greg. And I guess focusing on the integrity of the system is really important, but the system will keep changing as you add different layers. So, for example, what's the impact of this operation on bees, for example, and what's the actual financial and biodiversity kind of impact on that? Is perhaps disclosing environmental activities for private firms the right way forward, and can this help continue to unleash private capital into this market?
So on the private side, it's actually more complicated for private firms. On the public side, it's relatively straightforward. There's a standard they have to meet, and you just can't mislead your public. But on private firms, that's a much more complicated analysis, because now you're into issues about competitive advantage, kind of the secret sauce, and how much are you going to give away about what you're doing properly. But at the same time, it's the other side of climate that's become a much bigger issue for companies. This is now a real genuine people issue. So by that I mean it's what drives people to work in certain places now. So it was not as important before. People didn't go to work thinking, I want to work for X because I like what they do and I feel good about their products and everything else. There was always some of that, and some of it is for kind of doing that anyway. But now the focus on what your climate strategy and your environmental strategy is as an employer it's much more significant. And so the balance is you can't obviously you have to disclose that if you're going to use it as a marketing tool. So we just on the private capital side of that though. It's a similar focus. You're going to have private capital is going to focus on very specific things that they don't want to get in trouble for in many cases. So you're going to have to match up what your disclosed environmental activities are with private capital that matches with those. So your industry may be something else, but how you're going about it environmentally has to match up with the objectives of this private capital. So it's an interesting dynamic, but right now we've seen it in the last couple of years. We've seen a lack of funding for, say, oil and gas infrastructure as a result of certain private capital taking a view that that's just an investment we're not going to make anymore. And because it's private capital, they just simply don't talk about it. It's not like with public money, you'll see they'll put out a statement saying we're not investing in that sector anymore because of X. Private capital, they just turn and walk away. So it is a little bit more complicated to try and get a match.
Yeah, thanks, Greg. And an interesting comment from one of the attendees, and I definitely asked for the panel's views on this. Oil and gas companies have been reporting carbon emissions for quite some time, but how does assessing and improving commodity production like mining and processing like smelting actually compare to that? Are there real opportunities, and how great are some of those challenges? So not just offsetting, but actually improving the processes kind of fundamentally. Any thoughts from the panel?
Just a quick thought there, Dipesh. I think if you talk about the mining industry, I think this was always part and parcel of the mining industry. So, pre-Kyoto, when there were, I think we talk about smelting processes, etc., technology and R&D was there to remove SOxes and NOxes from the air. So as, smelters or other processing plants were developing and investing in this technology themselves, and the technology became available, it wasn't required, perhaps at that point legally, but for a lot of them. And also remember where they operate, they aren't operating for the most part in the developed markets. So they were operating in economies where the legal framework there wouldn't have required them to do any better. Yet it was off their own bat that they retrofitted a lot of these manufacturing and processing plants to reduce greenhouse gas emissions, etc. So I think for the mining industry, this has always sort of been part and parcel. And I think as more, so even if you talk about offsetting, if we look at where we are today and we have to meet those net zero targets, we're not going to get there just by offsets and reduction in renewables, but we also need a lot of investment in research, development, technology in things like GHG removals, etc., that Greg mentioned earlier.
Thank you very much. So now we're going to, and Tasneem, I'm going to come back to you, and we're going to go into a bit more detail on standards and ratings, and actually per many of the questions from the audience today. Tasneem, are the current sustainability rating schemes working, or are there too many?
Oh, again, another difficult question. Look, I think data, rating, reporting, they all intricately linked, and I'm sure my fellow panelists will have some views on all of those. But if you look at, let's start with rating, right? If you look at sustainability indices and ESG agencies, they are important sources of information for both socially responsible investors and to the investment process. However, different ESG rating agencies provide opinions on different aspects of sustainability performance. So if you took a whole matrix and you put in FTSE4Good and MSCI and Sustainalytics, some of them are more focused on environmental, some of them are more focused on social aspects, some more on governance. So what you get then are data gaps and certain assumptions made in producing ESG ratings than you would have for credit ratings, which are much simpler. So I think despite the proliferation of sustainability indices and ESG agencies, there's no standard methodology for evaluation of companies. And as I said, the reason for this is because the index or the different agencies give different weightings to analysis criteria. There are also differences between the scoring systems because each index and each agency expresses the results in a different structure. And also the information provided by ESG agencies regarding the measurement of risk sometimes is quite heterogeneous, and often we find quite insufficient. So what you're left with from a company perspective, they faced with the lack of information that makes it difficult for them to discover what actions they need to take to be able to open a door into one of the sustainability indices. And from the investor perspective, it's also difficult selecting sustainable targets for investment. I think the fact that there's so many ESG agencies and that each one uses a distinct methodology suggests that the future will show a process of mergers. And I think over the last 2 or 3, 4 years, we've seen a lot of that already. And what we'll be left with are the strongest agencies in the market and maybe a more funneling into a more standardized approach. I think that's where I see the future. And if we go from ratings then to reporting, if you look at the trillions of dollars, I think you quoted some numbers now from The Economist, going into the sustainability arena, the push for high quality, transparent, reliable and comparable reporting by companies on climate and other ESG matters has never been greater, right? So I think it was Greg who mentioned the ISSB. Now, for years now, there's been so much talk around an IFRS type standard for ESG. And last November, the IFRS board announced the creation of this new setting called the International Sustainability Standards Board to help answer this call. And their intention is to deliver a comprehensive baseline of sustainability-related disclosures that at least will give investors and other capital market participants the information about company sustainability-related risks and help them make better informed decisions. And if you look closer to home in the UK, I think, the ISSB standards will build on the work of the TCFD. And we also have the sustainability disclosure requirements, which I think will go further, requiring wider information on how firms impact the environment. So I hope that sort of covers some of the aspects on rating disclosure.
Yeah, thank you very much. And that's a very good overview from both that ratings perspective and the reporting perspective. Veronica from the audience says third-party assessment according to a given standard may seem ideal in theory. And also on to my next question is, how can that actually work in practice? So Tasneem, if you take the view of a commodity producer or trader, what do they actually do now that they've got, a wealth of agencies that they can use? They've got a number of different reporting agencies. What are the tangible next steps?
Well, already many companies within the natural resources sector have selected specific models. So I think SASB, for one, is quite popular because it tackles issues surrounding natural resources, commodities, mining, etc. So if we're talking specifically commodities, I think, there is something that is much more focused to which they can apply. If you were not relevant to this conversation, but if you were talking about buildings, for example, there are 4 or 5 different standards there. So I think it's horses for courses at the minute while we wait for this particular ecosystem to evolve to something that is much more baseline and much more standardized. But Greg, I don't know if you want to add anything there, because I think you have much more experience on that.
No, your assessment, I mean, it's a perfect summary that, in a way, companies are now caught. So we're seeing, especially in the last year, it's a bit of, I'll call it pressure, but pressure/shaming that, oh yeah, that's fine. You're disclosing, per these 5 standards, but you didn't disclose per these 4 over here. And why is that? Are you trying to hide something? And it's in most cases, it's not that at all. The idea, like what you've just described, this regime of reporting and measuring, it takes an incredible amount of time, because especially in the public sphere, companies have to get it right. They can't just kind of eyeball and look at, assume and guesstimate numbers, that kind of thing. They actually have to measure these things and be able to back it up if they get called out on some of these things. And so, they've got teams of people that they have to devote to reporting all of these different metrics. And so it's difficult to take on, more than one reporting scheme and comply with it all the time on an ongoing basis. So not to mention the downside of it, if you do get it wrong and then you're accused somehow of misrepresenting anything. So, and this is all relatively new. Like, companies obviously we've always had financial and accounting internal controls and management oversight, etc. But the whole idea that you would measure your environmental impact, that's a relatively new thing for most companies. And so it's a new cost overlay. It's a new human resources overlay to have the people to do it. So it's not a straightforward answer to that question.
Can I just add one final comment on there? I think, Greg makes a very important point that this goes above and beyond business as usual. So it's not just running the day-to-day operations, but this is like, 100-fold more input of people and time and reporting. And that's why companies like Carbon Chain are so important, because they're able to take that burden off the data analysis before that can be reported. So I think some of the work that Adam does is very, very interesting in this sphere.
Thanks, Greg and Tasneem. And actually that kind of falls quite nicely into our final section discussing technology and data. So Adam, over to you. Can you give any examples, and Carbon Chain is probably the perfect example here, of how data analytics and insights can help ensure that sustainable transition?
Yeah, thanks. We definitely spend every day doing this task for many different customers, some of the world's biggest oil and gas and metals and minerals companies. To the second part of that question, though, that was asked before, what are the implications for SMEs in these supply chains? I just want to echo a point there. I do think SMEs are disadvantaged a little bit because they don't have these large teams that are focused, but companies like Carbon Chain can automate this. And this is where we need to really democratize this information for the benefit of the entire supply chain, for the ecosystem, for the markets that are supporting them, and make that available. And I think we're starting to see the decommoditization in a way of commodities. And so we're identifying what is a low carbon version of that commodity, what is a higher carbon product. And I remember talking to a couple of sectors last year, and they were saying that they were seeing price separation for green products, even though it wasn't officially launched. There are actually some players in markets that were differentiating the suppliers based on their green credentials, and a premium did occur for that. And I thought that was 2 years ago, I thought that was a bit of a myth, and I thought it would take a long time, but we actually saw the natural market forces do that, and we could see it happening on the Carbon Chain platform. And in terms of how solutions like this can help and how technology can accelerate things, in 2021, Carbon Chain was able to model over 60% of the world's emissions, and that was through focusing on the high intensity areas like oil and gas and the supply chains and logistics mechanisms that transported that. And that's something that should be offered more widely, and we're seeing a lot of banks offer companies interest rate reductions, for example, simply for measuring, just for getting that awareness in place. And we think that's a huge enabler. If more companies are starting to adopt that as their kind of triple bottom line, what is that ESG cost, then they're really creating some more opportunities. And I've got to say, it's quite incredible that to address another question that came up in the Q&A, are commodities traders really caring about this? We're literally talking to CEOs of some of these trading firms who are allocating millions to direct carbon sink assets, and what would have been day-to-day trading activities, they're actually looking at how do they decarbonize. And it's a very powerful part of the financial system to enable there, and it's good to see that response. And they're doing it because they can measure with third-party credibility to what they're doing, and they can start to get acknowledgement for their low carbon strategy, which wasn't the language of business a couple of years ago, but now it's becoming let's call it a carbon accounting literacy. People need to know the language of boundaries. They need to know the language of what is well to wake, or what is mine to gate, what is cradle to grave. And executives need to be able to know what that is, so that we can start comparing across industries and across companies. Because I think to another point before, oil and gas companies were often using different standards when they would report, and we've got to clean that up now too. And so every financial report has its own almost carbon balance sheet. It's just a standard inventory item, and I think that's where we'll start see a lot more recognition in the market for some of these really good strategies that are being executed now.
Thanks, Adam. And can you talk about, can you go through a couple of examples? I know we discussed one that you had in mind to go into a bit more detail around, perhaps switching suppliers, decarbonisation, etc. Yeah,
so if a customer of ours is trading a certain commodity, they're able to get us that single trade, and it's on a ship, it's a cargo, and look at if that is high carbon emissions compared to the global average, or if it's very low, and be rewarded for that. And that was impossible a couple of years ago because a company might say, well, our scope 3, aka supply chain emissions, are kind of unknown. They're outside of our responsibility. And how could we know about that? Well, we know about it. Like we've done the database. We have every mine, most oil wells, 130,000 vessels in our database. And so we're tracking this in a bottoms up way. And it's almost like forensic level carbon accounting, but just to do this. So when we can then help a customer find out if their activity on a single transaction level is good or bad and be the referee of that, that's a great step forward for the market. And that's why some banks are willing to take some big bets on action and reward it accordingly, and possibly even come up with punitive charges in future if companies aren't actually taking a green initiative when there is an obvious change in supply that they could do, or if they're shipping things the long way around the world, or just to get cheaper shipping rates when they could have actually picked a greener vessel and gone a shorter route.
Yep, very, very interesting. And how do you see these technologies improving in the future, and what issues do you see them kind of solving?
So I think we're going to start to see real-time dashboarding of carbon emissions. So we've built this for some customers in that they just want to see how their day-to-day movement of goods is going, and they can almost see their carbon footprint accumulating on a daily basis. So that gap will be reduced. I find it quite difficult for some companies that invest heavily in carbon accounting now, but they're often limited to this retrospective look. They get to the end of the year and then they find out what happened, and you can't make proactive decisions on that. You need to be able to forecast your trades. So at Carbon Chain, we're focusing a lot on giving a trader insight before they've executed the trade on what would be the carbon position of that trade. Is it going to help them get a discount in finance, or is it going to be something that's a lot more inexpensive to offset if they wanted to create a carbon neutral trade? And then giving them a chance to react so that they're not managing their business from the rear view mirror of the car. And then also plugging that into the offset markets and filtering quality of offsets. It is quite a treacherous space still, the offsets. They're almost like a fiat currency in some areas, and I guess we could almost do another call on that. But to identify, I guess, to support the retreat to quality, which I think is slowly happening for offsets, when you can link the accounting to the offsetting action, that's a really powerful day in the office for one of those traders or executives that's trying to do business in a greener way compared to how they were doing it yesterday.
Thanks, Adam. Some really good examples and thoughts there. So I guess very conscious of time, and in order to close this off, I'd really like to hear from everyone in the panel just some overall thoughts and takeaways. What can we expect to see over the next 12 to 18 months, and what will each of you personally be working towards in your respective companies? Greg, I'll start off with you, please.
I think for us, on the legal side of things, the biggest point that, and we've hinted at it a couple of different ways here with rating agencies and everything else, there's a word that's now in all of our discussions, stakeholder. So that now we just take that as sort of, it has a, it's not a surprise when somebody says it, but 15 years ago, a stakeholder was somebody that had a legal right to have a say in your business. So it was a shareholder, it was your creditor, it was the government agency that gave you your license, it was your board of directors. And that was about it. But now, as we saw at COP26, the pool of stakeholders that are pressuring companies on this front, it's not just your customers, it's not just your suppliers, it's not just your government agencies, it's the public and the pressures that come from that. And so companies are going to have to adapt to absorbing all of that information and deciding which stakeholders they're going to take their marching orders from and which ones are not. So that's going to be part of the discussion. And then just finally, there's a reason it was called COP26, because there's been 26 of them before. And so, 25 before, and there'll be more after. So it's an iterative process. So, all of us that are here today we're on top of these issues, but they're not getting fixed overnight, as I said earlier. So it's important to use things like technology to advance these things, but it's going to take time.
Thank you very much. Tasneem, over to you.
So we talked about SMEs and the pressures that supply chains are under. And I think I will be really focused over the next 12 months, in particular, on working with SMEs in supply chains on their sustainability and transition journey. So that will be my focus. But I think with regards to COP26, what was really a key takeaway for me, or that really, I resonated with me, was the fact that it was really focused on implementation this year over process, putting science at its heart. For me, that was a strong indicator that the Earth really has a shot. And there I'm borrowing from the Duke and Duchess of Cambridge's Earthshot Prize. But we've got to work together to uplift the brilliant people, like people in Adam's company, with respect to what they're doing and all of the ideas around us. I think the lesson that we should take from the COVID pandemic is that we're all in this together, both the developed and the developing world. And those countries that are ahead of the curve need to ensure a just transition. And here I'm thinking about the island states that went away feeling quite disheartened. Yeah, I'd like my 3-year-old son to be able to visit the Maldives, not to go diving to see what was there once upon a time. But also a shout out to developing nations like my birth country, South Africa, for example, where, countries are able to take national responsibility for the changes needed. And in the case of South Africa, you saw they were able to attract $8.5 billion worth of funding for their transition. So I think at the end of the day, we are all on a journey. No one has all the answers, and that's why the best way forward is to work together. Thank you, Dipesh.
Thank you so much, Tasneem. And Adam, over to you. What's on the horizon for you?
Yeah, thanks. I can really echo the working together point that you guys have mentioned here. We actually see it in empirical terms when a customer of ours just engages up the supply chain or with their ecosystem of banks or insurers. They're getting a lot more benefit. They're finding ways to reduce their carbon footprint, and they're actually getting a lot of first mover advantage. There's sometimes cases where they might just speak to a logistics provider, and they'll say, can you pick greener ships? And they're the first person to really ask that. And then the supplier's like, yep, we can. There you go. Free carbon reduction right there. So I would say helping those customers just ask the question to their stakeholders is a really powerful 2022 move. I think we're going to see the democratization of scope 3 information get out there. So it's no longer going to be acceptable to have a broad brush estimation of your carbon inventory as a corporate. You're going to have to go down to nuts and bolts and then talk about that and know each supply chain, where things are coming from, be responsible for the provenance of your goods. And I think we're going to see industry bodies in 2022 pulling together to help those SMEs. So if you're chairing, if you're part of an industry body on this call, you're thinking, how can you help your members to pull together some certain resources to do a bulk discount on their carbon accounting? How can they just get some cheap option in so that they can get that carbon nomenclature in place and start to participate in that market? And equally in terms of offsets, like trading bodies should start to pull together and figure out an offset strategy with a larger buying power so that they can buy different carbon sinks or look at more technology investments like direct air capture, where regardless of how the sentiment of offset changes, if you're literally removing carbon from the atmosphere, that's one of the premium grade carbon reduction steps that if you invest now, you can really reap the benefits from that in a 5 to 10 year horizon. So we'll be helping customers with that journey speak the language of carbon and just do the right thing to help us hit that net zero goal together.
Thank you very much, Adam, Tasneem, and Greg. I think just some of the key points from there. We really need to apply some pragmatism to what is an incredibly big challenge, but we have the tools now to really move from implementation, using the science to execution. We also definitely need to think about the SMEs involved in the supply chain. as we transition towards a more sustainable future. And working together is key, getting good data is key, and using good technology is key. And hopefully industry bodies, associations, etc., can really help us get to that place. So thank you very much once again to our fantastic panelists, Greg, Tasneem and Adam. Thank you to the attendees, and Nick, back over to you.